Hello there and welcome to another episode of Retire Well with Wealth Advice. My name's Joe and I'm joined as always by Matthew, and today we're going to be talking about tax-free cash in retirement. What is it? How can you use it? And what's the best way to use it going forward? So it's one of the most common questions that I think we have as financial advisors, particularly when you're speaking to potentially prospective clients, but also just the general public and family. It's about what is the tax-free cash, what can I do with it, and how best to use it. And from experience, it's not always a one-size-fits-all approach. There's always general norms of what most people do, but everyone's different with regards to it. And what I think a lot of people don't look at is potentially the longer term impacts of one choice over another choice. So we're going to explore that all today, starting off by first understanding what the tax-free lump sum is, and then next look at sort of how to use it. So Matthew, do you want to start off by just running through, in simple terms, what a tax-free lump sum is?
Yeah, definitely. So people often say, okay, I understand that 25% of my defined contribution, so my flexible pot, is available to take tax-free, but that often then leads straight away to extra questions because they go 25%, but when? So that some people say, okay, is it when I first enter retirement and then I'm locking in a number and I've got 25% available to take? And then other people, I've had someone who said, okay, is it 25% each year? And then we've had people who say, okay, lots of people say, I've got 25% available, so I should take that straight away, and then I've got it. So, when we think about tax-free cash, essentially what it is 25% of your uncrystallised pension. So uncrystallised is a bit of jargon, but essentially if you haven't taken anything from your pension, you've got 25% of that total value available to pay out as tax-free cash. You could have that paid out from your pension as one lump sum, or you could have it paid as multiple lump sums, or you could have it paid as a regular income. So again, that's when in lots of our episodes we've talked about how much income does someone need, what sort of lump sums do they need, and we can match those incomes to it. So that tax-free cash is available to be used against it. Crucially, if you take some tax-free cash and you crystallise some of your pension, you then still have 25% left of the uncrystallised pension going forward. And if that pension grows, so does your tax-free cash. So, that's the common question of, is it just that I have to say I'm retired and then 25% is available? No, it's always 25% of that uncrystallised pot that is being revalued on a daily basis, and that's available both for regular income or lump sums.
Yeah, and when we're talking about the tax-free lump sum as well, it is limited, so it's not unlimited tax-free cash up to 25% if you've got a £2 million pension. It's limited to 25% of what the old lifetime allowance was, which is now no longer existing. It's £268,275 is the maximum amount of tax-free cash that you can have, unless, of course, and this is where pensions get quite complex, if you've got any scheme-specific or individual protection, which is essentially looking back at legacy pensions, people who previously might have been entitled to a larger amount of tax-free cash. They don't want them to be disadvantaged. So those are the potential instances where you might have more available.
Yeah, and people commonly, would say pensions are a complicated sort of product. And even in what we've just talked about there, we've used jargon like crystallised, we've talked about the lifetime allowance, which is gone, but still used for this. And then we've got other people who might be entitled to more tax-free cash because they had enhanced protection based on previous lifetime allowances. So again, anyone who is impacted by any of those bits definitely wants to talk to a financial advisor and definitely wants to have personalised advice, because you don't want to do the wrong thing and potentially lose out on any tax-free cash. We also have potential pensions where there is protected enhanced tax-free cash. So people know about the 25%, but actually due to some quirky rules, you can have schemes where it's actually 33% or 30%. So again, you don't want to accidentally do something with that pension and move it and give up the extra tax-free cash that could be available. So as always, we think advice is important for people, but specifically in these, really important areas in relation to anything guaranteed or anything protected.
Yeah, and I should say, when we spoke about tax-free cash just then, that very much relates to the flexible world of pensions, the defined contribution world, which is mostly now the private sector. previously where DB schemes were much more widespread, so they were in the private sector and public sector. Nowadays it's mostly limited to public sector, the DB schemes, but that's your sort of guaranteed income that would be guaranteed for life. A lot of the time you'll be offered a lump sum with your pension, and that's different. It's not exactly 25% of something in your pension there. Matthew, do you want to run through what that actually is?
Yeah, so that's a common question where people say, I've got a defined benefit pension, so I've got a pension that I've built up by working for a number of years, and I've accrued a percentage of my pension each year essentially, and then in retirement I'm offered an annual scheme pension and I'm offered a lump sum, and then someone says, okay, but I might also be offered a transfer value where, the jargon there is a cash equivalent transfer value, which, as we've talked about in a previous episode, is almost the buyout that the scheme would give to you to say, give up this guaranteed income and move to the flexible world and accept this transfer value. People often get confused and say, well, why is my tax-free cash not 25% of that cash equivalent transfer value? Why is it a completely different number? And that's because the scheme rules has a commutation factor, and when you've built up that annual pension, you're then given the ability to give up some of the annual income in exchange for some tax-free cash, and that's where the commutation factor comes in. Often it's around 12 to 1, so you're giving up £1 of guaranteed income each year for the rest of your life in exchange for £12 worth of tax-free cash up front. And that's, people can say, depending on their income needs and lump sum needs, what's the best way to go. There are some pension schemes where they accrue separately, so the NHS and teachers' pension again can be slightly different. So when you're looking at your pension, and if it doesn't quite fit what we're talking about here, don't worry too much. That's just the specific scheme rules that you need to look at for yourself with that defined benefit pension.
Yeah, I think when it comes to DB schemes, they're always slightly more complex in how they calculate the tax-free cash and what your options are. Usually you'll have either between 0 and X amount of tax-free cash that you can have, and there's usually a sliding scale in there dependent on how much you give up of annual income to how much tax-free cash you can have. The big ones like NHS, civil service and teachers' pension, they've got some pretty good online portals where you can log in, project when you're going to retire, and then slide the scale to see how much you might get at each individual date.
Yeah, definitely. And again, a common question from people with those sorts of defined benefit pension is, should I take the maximum scheme pension? Again, Joe's going to say everyone's circumstances are different, and therefore we can't categorically say yes or no to anything. But, we find that lots of people want to enjoy flexibility in the early years of retirement, those sort of golden years, and therefore people often like to take the tax-free cash because, one, they've got it and they don't have longevity risk, if they weren't to have a long and happy retirement. But equally, people tend to spend more in the early years, and they'll match that by spending some of the tax-free cash.
Yeah.
Do you think that's fair?
Yeah, I think it comes down to that sort of front loading of retirement that we talk quite a lot, where if you've got the option to have £50,000, £100,000 up front from a DB scheme and then a lower amount of income for the rest of your life, once you factor in stuff like state pension and potential spouses' pensions in there, that'll give you a good level of guaranteed income post-retirement, then it's fine to take it. Again, it is important to make sure that lower amount of guaranteed income is enough for you, because it might be the case that if you were to take a higher amount of tax-free cash, you're left with less guaranteed income, and then therefore you're not going to be able to retire if you splurge your full tax-free cash in one go. So it's just about sort of pre-planning and make sure that you're comfortable with almost taking a little bit of extra risk or spending a little bit more upfront, and you're comfortable with having less in the later years.
Yeah, definitely. And one side of the defined benefit pension and those cash equivalent transfer values that we've had recently was we had a comment on a previous video which said, my transfer value has fallen over the years, so therefore my tax-free cash has fallen. And that makes sense for how that individual is thinking about their pension, but actually, as we've described, if they were to take their tax-free cash by the scheme, they'd actually be entitled to the same amount of tax-free cash, or if they've got a bit older, they might actually be entitled to slightly more tax-free cash, and it's only if someone accepts a transfer value that you move from the defined benefit sort of pension scheme to the flexible scheme, and then you've got that tax-free cash available. So we can see where the person comes from that approach, but the pension scheme themselves would say, no, your tax-free cash hasn't changed at all. It's exactly the same. And assuming that you were to take it down the defined benefit route, that would be completely true. Again, if you made the decision to transfer and you wanted to get, advice, anyone who's got a transfer value of more than £30,000 has to get formal transfer advice from a pension transfer specialist. So they would talk you through the pros and cons of it.
Yeah, I think that highlights sort of the reason as well of why you need financial advice to look at transferring a pension like that, because there are a lot of intricacies, and it might feel like you're getting less for your money, but in actual fact, the scheme pension's gone up with inflation. The tax-free cash might have gone up in sort of a revalued way, and therefore you might be better sticking with the scheme pension as opposed to another plan which might have previously been to transfer.
True, and just so we can box off the defined benefit pensions and the tax-free cash there, to bring more jargon into it, we're going to talk about AVCs. So they're additional voluntary contributions. So you could be accruing pension benefits in a defined benefit scheme, and you could then say, I want to pay in more, and you can essentially then build a flexible pension, a defined contribution pension, into the defined benefit scheme, and it's bolted on. And the massive benefit for this is when someone's looking to take tax-free cash in the future, most schemes or some schemes with the AVCs have got the ability to give up some of that AVCs for tax-free cash, and therefore you're not commuting, you're not giving up some of your guaranteed income for that tax-free cash. So if we go back to that 12-1 relationship, if you've got a pot of AVCs that was, say, perfectly aligned with how much tax-free cash you could take, you could actually use all of that AVC as tax-free cash, and then you have the full guaranteed scheme pension. So that can be really valuable.
Yeah, I think that's something that is most of the time a sensible thing to do, because if you can keep your guaranteed income level that's protected by inflation where it is while getting the larger lump sum, it's almost like the best of both worlds. When we see that quite a lot with clients. We're going to almost jump back now to the defined contribution schemes, and a bit of a refresh in what we've spoke about previously is the sort of different types of drawdown and different types you may be able to access tax-free cash. I suppose the first and most simple way of accessing tax-free cash would be in a similar way that you would with a DB scheme, and you'd only go down this route as if you're purchasing an annuity. So if you were to purchase an annuity with your flexible pension pot, let's say it's £100,000, you could take £25,000 out on day one, give the remaining £75,000 to an insurance company, and then in return they'd give you X amount per annum based on several factors like your life expectancy, interest rates at the time, that sort of thing. Yeah. So that's very similar to the DB approach of getting your lump sum on day one, and then the annual income. And we'd usually again advise that you do it that way because you get the tax-free amount as cash, whereas if you put all the pension into an annuity, then the annuity is potentially taxable dependent on what your tax rates are.
Yeah, and the only reason why you wouldn't is if you were really, really focused on that guaranteed income and you were hoping and expecting to have a long and healthy retirement, therefore you would benefit on that, inflation-linked guaranteed income.
Yeah, absolutely. The next two, I suppose, are quite similar to each other, and we'd look at these if we're not purchasing annuity. We'd look at these if we're planning on drawing down as and when from our pension pots. They are Flexi Access Drawdown, which we've spoke about, and uncrystallised funds pension lump sum, which is a very long word. Some people call it UFPLUS or UFPLS. Matthew, do you want to just run through sort of quickly the differences between them two?
Yeah, definitely. So drawdown is the most sort of bespoke method, and I would say that's the most popular method for retirement, and that is essentially to have two taps. You've got your tax-free cash tap and your taxable income tap, and we can use those taps to get you to your desired income. So, when people are retiring and they say to us, I would like £2,000 per month into my bank, please. We then say, okay, well, we can pay across your 1/12 of your personal allowance from taxable income, and then we can pay the extra from tax-free cash. They'll be paid into your bank on the same day, and that gives you a position where you've had your desired income in a full tax year and you've paid you haven't paid a penny of tax essentially. So, we see people smile when they're retiring. We see people smile again when we tell them that they don't have to pay any tax if they go through retirement that way, and they can use their tax-free cash essentially for the first few years worth of income, and that can be really tax efficient. Do you want to go through UF+?
Yeah, so UF+ is almost it's still flexible in a way, in the fact that you can draw from your pension as and when you want, but it's much more defined in how it's taxed. For example, go back to that £100,000 mark. If you were to draw £100,000 out, 25% of that payment would be taxable, and then 25% would be tax-free, and 75% of it would be taxable. And that works whether you're drawing out £100,000, your full pension pot, or in Matthew's scenario, if you were drawing £2,000 out per month, you'd have 25% of that tax-free and 75% of that taxable. I suppose that the difference between the two, they might seem quite similar in the fact that the ratios are the same. With Flexi Access Drawdown, I see it as tax-free cash and almost potentially taxable income, because if you draw in that taxable amount out of your pension, but you've got personal allowance available, then you can essentially get your tax-free cash, potentially taxable income, which isn't taxed because you're below the personal allowance.
Yeah, I think of it as more the two taps that you can turn on at different points, whereas the UF+ is more I'm turning one tap that has the ratio that's almost set in stone. So yeah, I think nowadays most people prefer drawdown, they prefer the flexibility. And UF+ tends to be there from more legacy older pensions. That tends to be or cheaper pensions that people might think about using when they're accumulating funds, but they might want to switch across at that sort of retirement point.
Yeah, and that's where we've spoke about it previously when we spoke about consolidating pensions and getting ready for retirement. It's always good to check with your pension provider if they do allow for Flexi Access Drawdown, if they only allow for UF+, or potentially if they'll only allow you to take your tax-free lump sum and get an annuity, because it'll almost always be the case that you've got an option to move pension to another provider, or sometimes even with the same provider, to get those sort of more flexible options within a pension.
Yeah, so what do people most commonly do with their tax-free cash? So again, we've talked about it lots of times on the podcast. Everyone's retirement is slightly different, and we're trying to build our plan to meet their income needs and their expenditure. But in general, most people are saying, tax-free cash is there to use towards any lump sums as you enter retirement. So the most common there is probably to say, I've been paying down my mortgage and I've got a little bit left to pay off. As I enter retirement, I could say, I'll have that lump sum paid out to match it, and then I'm debt-free in retirement and I don't need to take as much income going forward. Someone who is already debt-free can then use all of that tax-free cash as that regular income as we describe, and that can be the most tax-efficient way to do it. We can then have people who also go, I don't need to take any income from the pension, but I've got unused allowances. So with that, we can then pay out the personal allowance and the tax-free cash, and that could even potentially be reinvested into something like an ISA, which is then going to be tax-free going forward. So with that approach, you're almost preserving the tax-free nature and using someone's allowance. Other people go, I've used my emergency savings and my cash buffer, and I want to pay out some tax-free cash from the pension to almost top it up. We tend to say, well, actually, pensions with liquid investments, you've got the ability that within, say, a week or two, you can top up your cash balances anyway. So that might mean that people don't need to have as big a buffer, in retirement. But yeah, in general, it's all about matching that expenditure and matching what you want to do, and then you're actively taking the money out of the pension when you need it.
Yeah, I mean, you almost took all the options there. I thought I wouldn't have anything else to talk about. One of, I think, the big benefits of tax-free cash is when you look at a partial retirement, where instead of going that sort of cold turkey stop straight into retirement, and you're potentially looking at moving down to 2 days a week, 3 days a week, and still having earned taxable income, by drawing down on the tax-free cash, although you can use it as an income, in the fact you might need to top a £1,000 part-time salary up to 2,000, you could draw that from tax-free cash and not increase your tax burden, as opposed to if you were using something like
Easy for you to say.
UFPLS or UF+, where you have to draw down taxable income at the same time. You're potentially increasing your tax burden when you don't really need to.
Yeah, definitely. And I think the other thing to say there is if someone is phasing into retirement and they're going to use pension to almost allow them to go down to, say, 3 days a week, by paying just tax-free cash, we're not triggering the money purchase annual allowance, so therefore that's not restricting the amount that someone can pay into a pension going forward. Again, I feel like we've said that previously, but it's nice to reiterate how tax-free cash can be really powerful, and you can still have the ability to make those large contributions going forward and build up those pensions, but you can equally still say, from 55 and going up to 57, you're still able to get access to that tax-free cash and some income if required.
Yeah, and for any new listeners that are watching this for the first time, the money purchase annual allowance is essentially a reduced annual allowance. So while you're working and you haven't accessed pensions in the taxable sense, you can contribute up to 60,000. If you take a penny's worth of taxable income from a pension, that reduces down to £10,000. So that's the sort of scenario where you think, well, I've retired now, why am I really going to need to contribute into pensions? I suppose a couple of scenarios where I can think where you might want to only take tax-free cash is if you might go back to work. I think me and Matthew spoke about someone previously that they had retired or took a small pension when they were still working, took the taxable income, were eventually given a redundancy offer, and we looked at some really good planning where we're going to put lots into pensions, use carry forward of previous years, potentially putting 100,000 plus into a pension in 1 year, but then we find out that some taxable income was taken from a pension when they hadn't received advice, and then they're limited to £10,000.
It's a bit of a kick in the teeth at that point. So yeah, essentially it's that element of tax-free cash can be the really good planning. It could be the bit that you could still get access to, but you're not undermining your future ability to save into your pension. So yeah, perfectly described there.
And sorry, I was just going to say, and some sort of other potential pitfalls with regards to using tax-free cash without advice is this isn't necessarily as severe, but using tax-free cash inefficiently. Matthew spoke on it before. If we can use some taxable income from a pension between your retirement age and state pension age, that's when you can almost get that taxable income as tax-free income under the personal allowance. Whereas if you use up all your tax-free cash and then get your state pension come in, then all of your pension is going to be taxable essentially, because your state pension is going to use up the majority of your personal allowance.
Definitely, and if we're putting our tax efficient hat on, someone could also use the marriage allowance during that period, so they could use that. If a partner isn't using their full personal allowance, you've got the ability to move 10% of that between each other to access some funds from the pension, plus you've got the tax-free cash on top of it, and people love the idea of having that tax-efficient start to retirement where they're not paying tax for the sake of it. In your working life, you've got no control over the tax. If you earn more money, you pay more tax. In retirement, with good use of drawdown, you can actually start to take more income, but without paying the tax, and that then reduces the burden on the pension. So I think that's a brilliant way to plan and use it in especially that golden years where you might want to take more in the early years of retirement.
Yeah, and when we're talking about sort of taking tax-free cash and what to do with it and whether to take it, I think very much depends on whether it's come from a defined benefit pension or whether it's come from a flexible defined contribution pension.
Yeah.
With something like a defined benefit pension, we'd obviously say establish your emergency fund, make sure you're happy with the amount that you've got in cash, but then anything extra that you don't necessarily need within sort of 1 to potentially 5 years, depending on how much you want in an emergency fund, you could look at reinvesting it, and that might be in an ISA, it might be in a general investment account, just to ensure that your money is still going to grow in line with inflation and you're not losing out. On the flip side of that, if you've got a defined contribution pension, we'd say essentially leave your pension invested for as long as possible, because that'll help grow your tax-free cash for future purposes.
Yeah, I think the only time when we probably wouldn't say that would be if someone was then, turning 75, where there might be tax-free cash, which is tax-free for them, but if they were to pass away, if they were hit by a bus or passed away naturally, their beneficiaries would have the whole of the pension as taxable income, and that tax-free cash is lost. You don't inherit that. So at that point, you've got a planning opportunity where you can pay that out, and you could either gift it, you could put it in ISAs, you could do whatever you want with it, and then the beneficiaries can essentially have it tax-free if it's well planned. If you leave it in the pension and it grows, that beneficiaries are essentially paying tax at their marginal rate to access that pension. So that's just where we can squeeze the tax efficiencies at different points as well.
Yeah, and I think that's something that we'll probably talk about quite a lot over the next few years, with potential proposed changes to how pensions are going to be included within the estate for inheritance tax purposes. I mean, we could do probably a full episode on that ourselves, but it's one where we're waiting on a review from the government to find out exactly how that might work, and that might change how we look at drawing tax-free cash out from pensions.
Yeah. So is there any downside of taking tax-free cash? I think, the most classic one there would be if anyone takes too much income from a pension and it's invested, but it might not be a sustainable amount that they're taking, their pension could run out too soon. So you could theoretically use all your tax-free cash and then start burning through your pension, and you could run out of funds before state pension age, and you could be left with a hole. So again, that's one where George Osborne announced pension flexibility and pension freedoms, and it was essentially saying to people, we're trusting you to take what you want when you want, but the worry there, or the risk there, is that funds could run out too soon.
Yeah, I think again, it pretty much just comes back to always look at having that plan, and if you've planned it out and the income is sustainable, or even if it's not income, if it's a large holiday that you want to use, a milestone holiday with your tax-free cash, and it works and it's sustainable, it's fine. And it's just about being mindful about, if you've only got flexible pensions, they need to last till life expectancy, or to be honest, a lot of the time more than life expectancy.
Definitely. One of the other things we were thinking about with the rules was to say, someone in the past has said, okay, I've got £100,000 available to take tax-free from a pension. Can I then put that back into a pension, benefit from tax relief of 20%, and then I'll have more tax-free cash to take? Again, that sounds too good to be true, because it falls foul of the tax-free cash recycling rules, and they're quite strict on essentially, you can't be seen to be putting more into a pension as a result of having that tax-free cash paid out to you. Yeah,
I mean, we've spoke previously about your ability to contribute to a pension in retirement, and those tax-free cash recycling rules, although strict, don't necessarily limit you putting in that 2,880 per year. But it's just a thing of being mindful of it. If it does sound too good to be true, it probably is. So that's always something to look at. And if you are concerned, just speak to a financial advisor, and I'm sure they'll let you know.
Yeah, definitely. And I think that covers the majority of our tax-free cash bits. But I think the most common question recently, especially around budgets, is, do we think that the government are going to get rid of tax-free cash? Do we think they're going to change tax-free cash? Or essentially, should someone therefore do something now to preserve the tax-free cash that's available to them? I think your answer is going to be exactly the same as mine, and it's going to be we've heard for every budget that there's a rumour, and there was quite strong rumours recently that there could be some changes, but actually there was no changes, and anyone who had panicked and acted purely on some newspaper headlines or some rhetoric there was actually financially disadvantaged as a result of having that tax-free cash paid out. My personal view is any politician or any party that announces a change to tax-free cash like that, it's going to be very detrimental to them, because everyone's got a pension and there's lots of money in these pensions. So actually you would be upsetting a lot of voters. And in the same way that Margaret Thatcher was known as the milk snatcher, someone is going to be tarnished as the tax-free cash snatcher, or the equivalent, probably a bit more catchy, but it's going to be politically awful for them. So I think in the same way that the state pension has been honoured and the triple locks carried on, the tax-free cash for me is here to stay, up until someone does announce anything differently.
Yeah, I mean, my view is I don't really like to predict the future because you always end up being wrong at some point. So
that's a boring approach.
Yeah, I think what Matthew said is sensible, and you can only really act on the legislation of the day. So we'll plan where we are now, and if something changes, it's always a time where we have a conversation with clients and see if it's something that we can sort of help going forward. You do bring up sort of a good point though with regards to people that did take out tax-free cash ahead of the autumn budget about whether you can undo your decision. And there was definitely a few things in the industry press about whenever you make a decision like that, when you first crystallise, there is an option that you can almost walk it back within 30 days. But in my view, it's much more complex than it's worth. And there can be a lot of unsurety? Is that a word?
Don't think so.
Don't think so.
Yeah, there can be a lot of uncertainty.
That's the one.
Yeah, I read something in the press at that point where some advisors were telling people to do it, and then they were saying, "Oh, we can actually just pay it back in." Actually, one provider said no. They said cooling off is for a change of decisions, not just the regulation didn't change in the way that you expected. So they were almost asking for evidence of someone's circumstances changing, and people hadn't had circumstances changing. So again, I think that was where people panicked and acted too early. I had a couple of people who asked me the question at that point, should I take out tax-free cash? And my answer to them was, what are you going to spend it on? What's part of the long-term plan? If it works for a long-term plan for you, brilliant. But if it's just the emotional decision based on a potential change, then no, we have to stick to the long-term plan.
Yeah, I think if there's a use for the tax-free cash and you might have been using it in the next year or two and you just wanted that peace of mind that it was there, it could make sense. If it was a case of speculatively taking it out that legislation was changed, then just keep it within the pension.
And I think, I had one client who was using a lot of tax-free cash in that tax year for some home improvements, and they were taking it as regular income. So they said, okay, well, I'll just bring that forward because there is a bit of uncertainty and I'll have that paid out. The other people who rang up just to say I'd be a bit peed off if the government got rid of it and I'll lose it, they were the people where you have to say, okay, stick to the plan. There's nothing to change at this point.
Yeah, absolutely. So do you want to run through the key takeaways of the episode?
I think one of the key takeaways is the financial flexibility that tax-free cash offers in retirement, and it's really valuable for people to say, what do you want in retirement, and therefore how can we best use it to meet those needs? I think going all the way back to the start with the defined benefit pensions, it's about projecting what you can get and understanding your options, again, so you can meet those income needs and capital needs, efficiently. And then I think, it's also about not panicking or not being emotional when it comes to potential newspaper articles where people are trying to sell newspapers rather than help you with your pension planning. Do you think there's anything else to add to that point?
No, I think you've covered it all pretty well. As I always keep parroting, it's just about having that long-term plan, making sure everything's sustainable, and if you're not sure, speak to a professional and make sure it's there.
Definitely, and I think we would be interested to hear how people have used their tax-free cash in retirement. So if anyone wants to share their own stories or their own approaches, definitely please leave a comment. We always love hearing those.
Yeah, absolutely. So thank you very much for watching. We've got new episodes every Tuesday, and we'll see you next week.